part to any of those types of exercises is to recognize why there would be an aggregation in the first place, but to then recognize that it's happening. Now we can reverse engineer that by simply focusing on volume. And this is exactly what we were talking about this morning, exactly what we were talking about. Does anybody see any volume surges? Well, the volume surge that catches your attention probably is this one right here. Massive volume at that stage. Absolutely enormous volume. The second volume that would probably catch your eye is this enormous volume here. The third volume that catches your eye, possibly this volume here. You know, the volume's now dropping right out, and if not that volume, definitely that volume there. So there's the 4 volumes, right? So what did I suggest these volumes would be about? Well, they could either be accumulations or they could be the martingaling part of the process. We already know that certain locations on the charts are dominated by market makers doing things. And one of the keys to this is, and the good thing is that this class took place this morning, so it was before any of this happened, right? So you were able to see this as it developed. Now the key to these volumes is, of course, number one, that you recognize them. Number two, somebody somewhere is making a decision, and your job is to try and analyze that decision and try and figure out what it is, and whether you have any idea about joining in with that decision at any point. But the key to this is at least we understand it. So when I look at the S&P chart during this period, take a look at how this happened. Okay, so we've got this big aggregation here. We've got this big aggregation against this huge volume candle. If I move the price out of the way a little second here, and we can start to recognize some of that aggregation, we can see into the price zone there. Now, what I said to Argo was this. When we see this against the most recent bracket, we can start drawing out some other ideas. We can start drawing out some other ideas. So we can actually draw the measure against these brackets and start the whole process again. Now, obviously, at this stage, we're starting to already call a possible bottom edge. We've already seen the interest rate starting to flip. And as we start calling out these bottom edges, we've already got a couple of prices in mind into this as a narrative. We can start watching these prices. Well, look at where that volume came out, guys, right into that target price right there. And if we look at this volume area here for that little next phase, you can see that that price corresponded into that bottom edge. Now, it wasn't that volume. It wasn't that volume. But you can see that it started to correspond to the bottom edges. And you're starting to recognize that whilst it's not the biggest volume, it is also very big volumes. So you can see that the big volumes that come in, they've got to give us some information. This wasn't nowhere that we wanted, right? This wasn't in a location. So there was still selling coming in at that price, drove the price down to the next target. And the next target has a little increase in volume again. Look at the volume drop-off in those areas. Massive volume drop-off. And it's almost exactly as we were talking about in classroom this morning. The idea of these measures, the idea of these projections, giving you the target prices where you would expect to see the volume happening, and then seeing the volume happening in those exact locations starts to give you a few ideas about what is likely to happen. Turned out that those trades were pretty close to the bottom edge. As you can probably already see, they're pretty close to the bottom edge phases. Now, one of the things we also suggested was that you extend the bottom edge phase through. You extend the bottom edge phase through and you start looking at where the next projection is going to be, and the next projection, and the next projection. It's not a one and done thing. You keep doing it with these phases of the market. The market maker sees trading as lots of mini books, and they discount all these little imbalances. They discount these imbalance zones. They've already lost those. So their job is to rotate the next zone that they can rotate in. And that's why we see these elements evolving. If you lose $1,000 during during these imbalances, but you make $10,000 during balance, do you care that you've lost $1,000? No. That's part of the market maker's plan, guys. They always lose money on those drives. Always. I've heard some numbnuts in the